All right, so you're welcome once again to this is an MDC revision class with Samuel Evander. So the question that we are looking at is a question in August 2016, and here it goes. Pearl Tours Limited, operating in Western Uganda, has been experiencing a steady revenue growth since its incorporation. Okay. So before I can proceed to read more about the question, I think for me to understand more, let me start with the questions. The reason why I want to start with the questions is I want to be able to know the right information that I'll pick emphasis on. And it's the same advice that I would advise you as well, that even before you read through the detailed question, try to first look at the question, what the question requires, and then go back and then read, okay? Some other people prefer to first read through and then read the questions and then go back, but I prefer to do that because of saving time, especially when you have a very limited time. It's good for you to first understand questions, then you read the passage, okay? And then also before I do that, maybe I may forget this. Now, as you can see, section A questions are sometimes a little bulky, okay? And you want to make sure that you're not taking a lot of time on them before you can even attempt any of the questions in the next section. So I would encourage you that if you have gone through the 15 minutes, okay, and there are some questions that you feel you have confidence to do, okay, I would actually advise you to first at least do 2 questions in section B that you have full confidence over. What that helps you is that it gives you some level of momentum that even when you come back to the first question, you have you at least have some marks you've banked the other side. You get it, eh? So that is something I would want to say when it comes. So because section A is compulsory, you have no option but to do everything. You find yourself in circumstances where you spend a lot of time calculating even things that you're not sure about, yet you can actually earn some marks in the rest of the other questions. So first do that, and then you come back for section A. You will not be let's say, punished for that, okay? At least the examiner knows that. All you have to do is to make sure that you're numbering your questions rightly. So whoever is marking which question can easily find the question and be able to mark, okay? Yeah. So with that in the background, I want to just look at the questions here. So they are telling me that on the basis of profit volume ratio for the periods ending 31st July 2016 and 31st July 2017, advise Mr. Asi on whether she should carry out the planned marketing, okay? And then the next question says, compute the break-even point in number of tourists for their ending 31st July 2017. So they'll need a break-even point. And then they also want us to prepare a customer profitability analysis for both local and foreign tourists for the period ending 31st July 2016. And then the other one is advise Mr. Abi on how she can use customer profitability analysis results to increase company profits during the period ended that. And then they also want us to briefly discuss any 4 assumptions that gave the interpretation of the cost volume profit analysis information, okay? So I would now go and try to read through the question. So the question says, Pearl Uganda Limited, Pearl Uganda Limited, operating in Western Uganda, has been experiencing steady revenue growth since its incorporation. However, high growth rate of the tourism industry has attracted both local and foreign investors, okay? The company's president, Mr. Asiabi, is worried of the competition that may hit their revenue levels. She plans to improve on the marketing through redesigning their website during the period ending 31st July 2017 and to maintain the company's revenues growth. Okay, Mr. Asi expects this marketing to cost her shillings 15 million, but it will lead to an increase in 10% in local tourists and 18% in foreign tourists. Okay, there are no expected changes in the company operations during the period. Ms. Abby also believes that the company's customers should be segmented in order to concentrate on high value customers, okay, which is the customer profitability analysis trying to come in here. Okay, I think if you remember when we discussed about the customer profitability analysis, maybe I'll give more light as we proceed. So they're saying the company charges a fee of 175,000 for local tourists and shillings 400,000 for foreign tourists that it handles. So the following information has been extracted from the financial reporting period ended 31st July 2016. So we have tourist origin, we have local, and then we have foreign. So these are the number of tourists. These are the variable costs per tourist. I think you can see in every section. And then they also go ahead to give us fixed costs. So we have fixed costs, we have salaries, we have marketing, we have depreciation, we have overheads. So as you can see, these ones have not been allocated between local and foreign because they are fixed costs, okay? So they also go ahead to tell us that 25% of the overheads are apportioned equally to local and foreign tourists. 25% of other overheads, okay, of other overheads are apportioned equally to local and foreign tourists, okay? So your question should be, what are your other overheads, okay? So we're going to see that happen. So they're telling us that the company further revealed, the accountant has further revealed that the company incurred the following costs while dealing with tourists during the period. So we have processing activity, processing orders. We have 12,500. Then we have processing tickets is 2,750. Then we have telephone calls. This is 2,238. Then we have emails costing us that value. And then we have traveling to and from Kampala is also costing us that value, okay? And we proceed to also additional information. So additional information, we are seeing ourselves with the number of orders. We are seeing number of tickets processed. They have broken it down, okay? They have also given us a number of emails. Then they have also given us a number of travel to and fro, okay? Now, even before I look at this question, even before I look at what is required of me, every time you're given information about, let's say, I think you can see these are like cost drivers, okay? And these are like activities. So you know that you may need to apply some knowledge here of ABC. And by applying some knowledge of ABC, it means that you're going to allocate your overheads, not based on what? Not just based on less machine hours or labor hours, but there will be an element, because these costs, they have given you these costs in the way that they are general, okay? But remember, you have two categories of what? Of products. And one of the things that this question is also requiring you to do is to do a customer profitability analysis, okay? So at the end of the day, I think what these guys may want to understand is of the local and international tourists, which one is more profitable than the other, okay? Yeah. So they come here and says that on the basis of profit volume ratios, okay, for the period ending 31st July 2016, advise Mr. Asi on whether she should carry out the planned marketing. on the basis of profit volume ratio for the periods ending 31st July 2016 and 31st July 2017, okay, advise Mr. Asi on whether she should carry out the planned marketing. Now, you know what the profit volume ratio does, the CVP analysis, okay? Which CVP analysis believes that profit, and that when you speak of profit, we're speaking of costs, okay? As well as we're also speaking of revenue, okay? That profit, which is revenue, and costs basically depend on volume, okay? Now, we want to see something here, okay? That is bringing in the marketing cost, okay? So here you can try to read again, maybe especially the parts that you feel will help you to get exactly what this person is looking for. So they're telling us that Miss Abi is worried of competition, that they may hit revenue levels, okay? I think it should have been maybe they may not hit their revenue levels because of the competition. So she says she plans to improve on marketing through redesigning their website during the period ending 31st July 2017 to maintain the company's revenue growth, okay? Now, Miss Asi expects that this marketing will cost her how much? 15 million, okay? Will basically cost her 15 million, but it will lead to an increase in 10% of tourists, okay? And also lead to an increase in 18% in future tourists, okay? They're telling you that there will be no other changes in the company's operations. So basically, the only change we are seeing here is the marketing cost and then the increment in terms of what? In terms of our local tourists, and then in terms of our foreign tourists, okay? So basically here, okay, I think this may also help us. This is also going to help us ideally along the way, as well as the information down, okay? So that is, let me just try to also look at the second question. Sometimes when you also look at the second question, it helps you to know how the first question will feed into, let's say, the second question, okay? So they're also asking you here, compute the break-even point, okay, in the number of tourists for their ending 31st July 2017. And I think you know what the break-even point means here. At break-even, total revenue is equal to total costs, okay? So, and when they ask you for the break-even point, they basically ask you about in the number of tourists. They have actually asked you in number of tourists, okay? So you should be able to calculate that here. And then also, one of the things they have also asked us here is to prepare a customer profitability analysis, okay? Now, one of the things that we need to understand, that we have what we call, we have break even for multi-products, okay? We have break even for multi-products. Now, I think you might have come across it somewhere, somehow, but break even also, we have cases where we have more than one product, okay? And we have to make sure that we are trying to look at the CVP where we have more than one product, especially when we are trying to look at this approach, okay? But in just to highlight something small here is They have told us that on the basis of profit volume ratio for the period ending 31st July 2016 and 31st July 2017, advise Mr. Asi on whether she should carry out the planned marketing. So what you need to basically do, we are going to draw up a profit statement, okay? We are going to draw up a profit statement because, for example, on the basis of profit volume ratio for the periods ending 31st July 2016 and 2017. So let's just try to see if they have given us also information of 2016. So this is the information for the period ending 2016, okay? I just want to see how 2016 fits into how 2017 fits into 2016. So as you can see, the planned move, because it said she plans to improve on the marketing through the redesigning by the period ending 31st July 2017, okay? So it means that this additional cost is actually going to happen when? It's actually going to happen in the next financial year, okay? But as you can see, the information they have provided to us is information for period ending 2016, okay? So what we are going to basically do is we are going to do profit statements, okay? We are basically going to do profit statements for 2016 and 2017, okay? And that that alone should be able to give us the current decision, okay? So when I speak of a profit statement, what I'm trying to basically mean, we are going to look at the revenue, okay? We are going to look at the revenue and the respective costs, okay? We're going to look at the revenue and the respective costs. Now, for 2016, we have the information here, okay? If it comes to aspects of revenue, 2016, we can easily determine the revenue because we have the number of tourists, and then we have what? We have how much each tourist is actually paying, okay? So that is something that we want to appreciate. So we at least have the revenue of 2016. Now, in case we want to determine the revenue of 2017, in the profit statement of revenue of 2017, they have told us of how this revenue will actually grow, okay? So if you want to determine how many tourists you have for 2017, definitely, if it's for local tourists, you come and multiply this by 110%, okay? Because they're increasing by 10%. You can either do 10% of this value and then determine how much, determine what exactly the 10% and then add it there. Or you can just multiply this by 110%. The same thing will also happen with the foreign ones. They are said this will grow by 18%. So you can multiply this by 118%, okay? That is what you do with the revenue, okay? That is what you do with the revenue. Now, when it comes to the costs, we've been given the variable costs, okay? And of course, what you do is you do two columns. You do a column for local, and then you do a column for foreign, and then you do a total, okay? You do a total. Now, when it comes to the variable costs, remember these variable costs depend on the number of units. So what I'll basically do when it comes to wages, I'll definitely get 25, okay? Because this is 25,000 per tourist, okay? So if I'm doing for 2016, I'll do 25 times 1, 250, okay? And then for this, I'll do 40,000 times 763, okay? Now, and that's the same thing that I'll do for traveling. I'll also do for ticket purchasing. You get it, accommodation and food, okay? That is the principal I'll do. I'll just get this times the total number of what I have there. Taking into consideration, there are thousands, okay? And then if I'm trying to do something for 2017, what I'll basically do is since I've gotten what is 110% of that value, that is what I'll use, of course, like I said, that is what I use. I use when it comes to revenue, okay? When it comes to revenue. Now, when it comes to costs, I use the same basis, okay? I'm able to find my new tourist quantity by adjusting them by these respective percentages. And then I'm able to translate that into to determine what would be my wages be, what my traveling will be, what my ticket purchasing will also be, okay? So at least for the revenue and variable costs, you now have an idea of how to do that, okay? Now, when it comes to let's say, now we also have the what we calling the overheads, okay? Now, these that they have given us here, okay, are basically other overheads, okay? These are basically other overheads. And they're telling us that 25% of other overheads are apportioned equally to local and foreign tourists, okay? 25% of other overheads are equally 25% of overheads are apportioned equally to local and foreign. Now, other overheads value is here. I think you can see it. It is 30,520. Okay. So what you should do is first get 25% of this, and you remove it. Okay. Now the remaining overheads, we are going to treat them just like the way you're seeing the fixed costs, other fixed costs, okay? First, remove this and allocate them equally between local and foreign, okay? And then for the remaining fixed costs, the ones that we have, we're going to find a way of allocating, okay? Allocating them. And of course, at the end of the day, before you even get to fixed costs, make sure that you determine your contribution, okay? Now, there's some information here where they're telling us the accountant has further revealed that the company incurred the following costs while dealing with tourists. Now, these are also costs, okay? These are also costs that you're going to have to appropriate, kind of divide within the respective either local and international tourists. And that is why you see when you come here, they actually come and give you a breakdown, okay? A breakdown. So if I want to allocate, even before I allocate these ones, okay? If I want to allocate the processing of orders, basically what I'll do, I'll use, since this is processing orders, total of 500, I'll be able to come here, okay? Remember what we said when we're using the ABC, okay? We already have the cost pool. It's worth 12,500. Okay, so if I want to allocate a portion for local, I'll basically do 125. Okay, 125 divided by the total cost driver, which is 250. Okay, 125 times what I have here, the 12,500. The same thing I also do for tickets as well. Okay, I should be able to get my, this is 0, so this one would not get. So this when it comes to processing of tickets, definitely the whole cost will go to foreign. Okay, and the same thing I also do for telephone, the same thing I'll do for mails, the same thing I also do for actually number of travels to and fro. Okay, so that is how I would process these costs. Of course, they're also part of our profit statement. Now, when it comes to these other costs, okay, when it comes to these other costs of staff salaries, marketing, and depreciation, these ones, I'll allocate them based on what? I'll allocate them based on number of tourists, based on quantity, okay? Because as you can see, these ones, they have not given us an appropriate measure of how to allocate them, okay? So I'll allocate them based on the quantity of tourists, because I have to make sure I get a profit statement of each of these, okay? I should be able to allocate these respective costs. Okay, so that is very important. So once that is in mind, I'm able to get down and I'm able to find the respective volume. Okay, okay, the respective profit for each, and for 2016 and 2017, as well as the totals. Okay, now in assessing whether Mr. Asi should carry out the planned marketing is to do with, shall our profit increase? Okay, I think that is the question, and it will be demonstrated basically from what? From how your profit statement for 2017 will look like. Remember, they have told us up here, they told us that there are no other expected changes in the company operations during the period. There are no other expected changes in the company operations during the period. So it means that they'll have, apart from the change in the number of tourists and apart from the marketing costs, whatever you have on basically for 2016 will actually be the same thing for 2017. Okay, so some of these costs you'll be able to share them across the other. Okay, so that is how I would approach the question. So a team, do you get something?
Yes, I get something, but I had some confusion somewhere there on that the other overheads, because they're saying 25% of other overheads are apportioned equally to local and foreign tourists. I think if I go to it, said we get 25% of this 3520, allocate it
equally.
Allocate it equally. Then what happens to the balance? What happens to the other 25%?
The balance will be accumulated with the staff salaries, marketing, depreciation, and we shall allocate that based on the number.
Okay. I don't know if it's possible that we do it practical, at least this, because my main issue in the profitability analysis, if we drill, I don't know if time will allow, we'll do it practically for this number only, then you can give us tips on how we can be answering and all the other things. I don't know what the rest have to say, but I thought if we try this one practically, it would give us a broader idea on many others that we shall be meeting.
Maybe you could hear from others, but what I just felt like, if you've gotten the concept, you can actually try that out, because the question will take long. Okay, and I wanted at least to pass through other number one questions to try to guide you somehow, because the challenge is today they have set a question on this, they can set up a question on totally different topics. So I want to hear from other people what they think, and also if at all the guidance is helpful as well. Please proceed. Whoever wants to speak.
For me, my challenge was fixed costs you are saying, because I put staff salaries, marketing, and depreciation on their heading, it is showing fixed costs. Why are you saying that we are going to distribute them basing on the number of tourists?
Okay, now even if you have fixed costs and you have, for example, 2 products, ideally you should distribute them. Okay, yes, on your total, when you look at your total, let's say your total revenue and total costs and then total profit, it will be wholesome. But if you want to, because at the end of the day, you also want to see, because when we are going to get down here, remember one of the part of the question that we are going to look at, they have given actually right here. Part of this question wants us to determine the customer profitability analysis of the two of the 2 products. Now you cannot do a customer profitability analysis without allocating your fixed cost to both of your products. Okay, if you're doing, because at the end of the day, the customer profitability analysis is trying to look at, you're going to get one product, look at how much is the sale you make of this product, how much are the costs, and how much is its profitability. In the same way, you also do the same thing when it comes to the rest of for the other product. You also do the revenue and do the costs and then determine its profit. And then from that's what the customer profitability analysis basically does. So ideally, we should allocate them. You get it, huh?
I get you.
Yeah, we should allocate them. Okay. Of course, what you may do, maybe to not take a lot of your time, because the allocation may not be so much important for you here. You may not use the allocation so much on the first question, okay? Because this question is just basically looking at it from the general perspective, okay? Where are you looking at the totals? You may want to do what? You may want to focus on the totals here, where you look at the 2016 profit statement and then also look at the 2017 profit statement, okay, without the allocation. But just in case you want to be systematic as much as possible, because the information you're going to write here, you will actually just copy and paste some of it here when you're doing this customer profitability analysis. Yeah.
Thank you.
Actually, I think that is also what I was thinking, because I was seeing as if part A is actually more a duplicate of it's part B is a duplicate of part A. Only that part B you have to split them as per the local tourists and foreign tourists. So if you have also broken down part A, then it would just be a copy and paste under part C. Under part C.
Yeah, that is what would exactly happen.
And then I think, okay. So now, Mr. Samuel, if
Yes.
I got you very well, I think I was trying to take notes for the interpretation. And then when we're doing the profit statement for 2017, we shall consider the increase of 10% and 18% respectively. So for example,
when it comes to revenue, and then when it comes to costs, you'd include the marketing costs, because those were the only two changes that were happening.
Okay, so when it comes to revenue, would still do 10% of the one of 2016, get the 10%, and then add it onto the one of 2016, and then get what will be the total figure. I think there is, okay, you said 110%, which is the other way around, also it's the same. But then you said when it comes to revenue, when it comes to costs, we need to add the marketing cost. So that means the marketing cost is only for 2017.
Yes, because just from the statement, what exactly they have said here, when you come here, they have told you that she plans to improve the marketing through redesigning their website during the period ending 31st, 2017. So it means that even the cost will be incurred during this period, and there will be no any other change that will happen.
Okay.
You get it, huh?
Okay.
Yeah. So that is.
I think based on the direction we are taking, maybe it would be good if we would cover many numbers. If you just give us interpretations of many number one questions, I think it's okay. Then we shall try it on our own and see where we can go through with it. Because I see the rest are quiet. I don't know.
Yeah. Now, also, I wanted to emphasize something very small here. Okay. Now, for the questions that we have been doing, okay, previously, maybe I may not have hinted on that. I don't remember, but there is a different way to calculate the break-even point for malt products. Okay, I don't know if somebody has come across that. Has somebody come across how to calculate?
I don't know if I am trying to remember. I think it was multiple, because I saw when they used
Go on, you were saying?
They use the formula of fixed cost over the contribution per unit. And I think there they had more than 2 products. And that's what I came across. So I was also not very sure if it was the right way or.
I think you're breaking, but I can just try to comment about it here, and then you let me know. You let me know what exactly you may have. So just a moment. Okay. So right here, so the normal break even, okay, the break even point that I think we for a single product, I think you must be aware of this break even point. This is basically equal. Just try to put the equal sign here. So this is total fixed costs, okay, divided by, this is divided by the contribution per unit. Isn't that right?
That is the one I was talking about.
Okay.
Yeah,
so
it's the one.
So how did you get the contribution per unit?
The contribution per unit, I got the sales revenue minus the total variable costs.
You saying the sales revenue?
Minus the total
Minus?
variable costs. Total variable costs.
Okay. Now, was that for local tourists, or for you got the total?
No, I did for another number. It was not for this number.
Yeah, because remember, this is contribution per unit. This is not total contribution. Okay, this is not total contribution. So when you're dealing with more than one product, this break-even point changes. It becomes this. It becomes total fixed costs. This does not change. This becomes weighted. It becomes weighted average. The weighted average contribution per unit ratio. Has anyone ever come across that formula?
What's the difference between that formula, that weighted average contribution, and contribution per mix, where you get the sales mix?
Yeah, it's the same principle. It's the same principle, because in the same way we'll use the idea of the break-even point, like of the sales mix. You get it, huh? Yeah. So when you're determining the weighted average, basically you'll be able to use that principle. Okay. So for example, when we have, I think we have local tourists, and then we have foreign tourists. Okay, whatever they're sparing. So yours is to look at, yours is to list them and then determine, of course, we shall have the selling price, okay, of each of them. And remember, this question was asking us for which year were we looking at? This year is for their ending 31st December 2017. Okay, so we're able to get our new what we have here. We have to get, the selling price was not changing. It was just the increment. So the selling price was still the same, isn't it?
Yeah. Yeah.
So we have this here. And then we have, this is 400,000. Team, have you ever come across this formula? And then we also have a variable cost per unit. Now, the variable cost per unit, basically what we are going to do, since it's for 2017, remember the variable costs are not changing, isn't it? It's only the marketing cost is ranked under the fixed costs, okay? So we have wages. So you're able to get the total of this, okay? So this is 50, 120. This should be 120. And what is this? This is 100, 210, 210, 260, 295.
985.
It is what?
As if it's 285. Let me see.
It is 285. Yeah, it is. No, it's 295 because this is already,
okay.
this is already, yeah, 295. And then this was the other
120.
So this is 120. But remember, they have 1,000s on them. And this is it 195?
295.
295,000. Okay, so that is what basically we do have. Now, ours is also to go ahead to determine the contribution. The contribution per unit, okay? Which is definitely this minus this, isn't it?
Yes.
Okay, so that is what we have as a contribution. We can also go ahead to determine, let's say, now, in terms of, remember we have how many units we sell. So we can be able to get the sales mix, isn't it?
Yes.
Sales mix. So for 2017, of course, we are going to use the records for 2016 and then determine for 2017. So as you can see, we have 1,250 and 763. 1,250 and 763, and these are going to grow. 1,220, 763. So I can put it there. But this is for 20. This is 2016. So if I'm looking at one of 2017, they have told us that one will grow by was it 10%? This is times 110%, and then this will grow by 18. Is it 18?
Yes.
Yes.
118.
0.2. Okay, 118, like that. So this is what we have. Now,
No, it's
if we want to,
18%.
it is
18%. Yeah.
18%.
Oh, thank you. Okay, so that is what we basically have. In case we want to determine, of course, get this a little down, because this is already, our sales mix is 135 to 900, but you can try to reduce, maybe divide by the smallest. So you have 1 to something, okay? But with that in mind, so remember our formula is actually total fixed cost divided by that. So who was trying to guide us? Was it Henry who had done this before? I want to see if you're on track, if it's the same principle.
Yeah.
So
So for us to get the the contribution per mix, which is the same as this weighted average contribution. We multiply we multiply the contribution per unit with the sales mix.
With the sales mix,
Yeah.
So you're saying we multiply 55.
Yes, with that 13, that 13.
So 55 times this, and then
900 times this also.
And you call this?
That's contribution per mix.
This is contribution per mix. Contribution per mix. Once we have that,
then we can now get our break even, because we know our.
How do we bring it to? Would this be our weighted average?
Yes, it's the same as, so we just get the total. No, like we get for each product, we need to get for each product. Yeah, I think, we can get for each product differently, because total fixed cost, no, but the fixed cost is like for all of them. So definitely we need to add them, then we get it. We get a total fixed cost divided by that, figure of the contribution per mix.
Sorry, my network is disturbing me here. So have others gotten what you're trying to explain, Henry? Have you guys gotten what Henry is saying?
No.
You've not gotten it, huh?
No.
Okay. So what I was saying is we've been given we have the fixed cost, okay, at hand, and I think ours is to determine what do we use as our weighted average contribution margin, okay? So Henry, were you saying that we add these two together? Is that what you were saying?
Yes, that's what I was saying, that we add them. So maybe you can correct me somewhere there, I think.
Okay. The approach, and this is the approach that I was going to basically take, was to basically also determine in terms of I'll determine my contribution. You try out and see if you come to the same answer. The contribution margin ratio, okay. Definitely, what I'll try to do here is by contribute. I'll just get this, okay. Basically, this divided by this, okay. So I get that put this in percentage. Okay, I have 31 and then 26%. Okay, so with that in mind, the next thing that I'll do is now to calculate my weighted average. Okay, weighted average. And how I'll do it, I'll just come here and say local tourists. Right. I'll say local tourists, and then I have my foreign tourists. So what I'll have is I'm going to multiply, and we're going to see if we can. So I'm going to multiply this that I have here, okay, times basically the sales mix, okay, times basically what I have as my sales, because at the end of the day, I have, this is what I have. Let me just try to do this. Let me have the total. Okay, so total is a summation of this. So in getting my, what I'll basically do, I'm going to get my 31%, okay, times my 1375. Are you seeing? And then I'm going to divide this by 2275. Are you seeing what I'm doing?
Yes, we are following.
You're following, eh?
Yeah.
Okay, okay. So what I'm going to basically do, okay, instead of using the percentages, let me do this. I'll basically just do, let me just get the 55 directly. So I'm going to get the contribution here per unit up here, okay? And then I'm going to multiply it basically by this ratio, okay? Which will be 1375 divided by 2275. So this is what I'll have as, this will be my weighted average CM, and the other one will be 105,000 times 900 divided by 2275. Right. So that is what I'll basically do have. And then what I'll do is I'll get a summation of this, which gets me to 74. So my formula will basically be, I'll get the total fixed costs, which I can get from the other side, and then divided by the weighted average contribution per unit, which is this 74. Now, the only challenge that comes with what Henry you had given us here, I think you saw that these figures are even huge in themselves. When you add these together, these are already huge values. So what you did by multiplying this times this directly is you're supposed to multiply by the ratio, not directly. I don't know if you get the principle.
True, you're right.
Yeah. So that is where you, so you're not supposed to do this, okay? Rather, you're supposed to come and get the contribution, okay? Maybe the percentages may confuse you. I may also remove them. At least you know up to here, and we also know that this was the 2017. So I may even remove this 2016 for you. So you're able to determine your weighted average by doing the 55, okay, 1,000 times 1,375 divided by 275, and then the same thing with 105 times 900 divided by 2,275, like that. So I hope other people have also. Atim, have you gotten it? And maybe the rest? How would calculate that break even?
Yes, so that means the 74,780 is now our weighted average that we're going to get to the fixed cost.
Yes,
Okay.
it's our numerator. It is what you would what would be your contribution per unit if in case you are using a single product. You get it, eh?
Yes.
So that would be basically the principle. Yeah, that would be the principle. So you've understood about the customer profitability, what you may need to do when it comes to customer profitability. Customer profitability, and the reason why we conduct customer profitability is, of course, to understand which of our products, let's say, is more profitable than the other. And the principle is you should concentrate on the profitable product and do all that you can to actually move your customers who are on the other product, this other product. Okay, but I think for example, for this kind of business, we cannot have the local move to foreign. Okay, so the whole principle is just to concentrate on what may come out as profitable. It can either be the local, or it can either be the foreign, based on the analysis. But the analysis would come in when you've actually done the allocation of the other costs, like the way somebody was asking me, why are we allocating the fixed costs? You can only get the customer profitability of any of your products by allocating your respective. So this question basically even had the ABC in it, okay? As you can see, okay? Yeah. So that is, I believe that I've given you some guidance on this question. So did any one of you come across any other question that you may need also some guidance? Before maybe I just find other questions. Do we have any other specific question? I've tried to mute you up. So
there is one more question. I think it's also 2017.
2016, 2017.
I think it's 2017.
2017. Which year of 2017?
I think it's in December.
December 2017. Just a moment. This November 2017, eh?
No, it's June, eh? June.
June.
Question 3, but that. Oh, you're looking at mostly question 1s.
No. It's we can also look at because what can actually come. Question
Sure.
1 is, yeah, can also come the other side. So
yeah.
I hope this is the question.
It's for PFM. June 2017.
Okay.
Yeah.
Can you see my screen? No, it has gone off. It's okay. Let me just share the question here. So must be this one, June 27. Which question? Question what?
Question 3.
Question 3. Okay, question 3 is for Pakasa. Let's just get down onto what is the required. So they want us to advise PFM on whether it should close its upcountry showrooms to take up the strategic alliance with distribution agents based on the forecast of July 2017, and that 3 other factors should consider. I think this is like a short-term decision, decision-making question. So let's just try to look through and say Pakasa Furniture Mart is one of the leading producers of class dining and sofa sets in central Uganda. PFM has upcountry regional showrooms in Mbarara, Mbali, and Gulu. Lately, PFM has suffered turnover downturns due to stiff competition from the furniture importers, government regulations on timber production, and emerging upcountry workshops. PFM incurs annual fixed costs of 550,000 and the following unit variable costs. So we have dining sets and then we have sofa set. So we have, they are telling us that below are the sales extracts for the month of April 2017. So as you can see, we have the output and then the sales price, okay, for Kampala and upcountry. So they're telling us that sales from upcountry showroom have been uniform for the last quarter. And if nothing is done, this sales trend is expected to continue through the coming year ending, such as June 2018. PFM has decided to evaluate the proposed strategic alliance with 3 distribution agents, Western, Eastern, and Northern region, who have the capacity to penetrate the market in neighboring countries. If PFM accepts this proposal, the upcountry showroom will be closed, okay, with effect from July 2017. And this will decrease the variable costs by 70% and increase the fixed costs by 25%. Okay, this also decreased the fixed cost by 25%. So they go ahead to tell us that distribution agents have already put in place a sales order for July 2017 for 60 dining sets and 150 sofa sets at 1 million. PFM expects to sell 15 dining sets and 20 sofa sets in July 2017 for Kampala. Advise whether PFM should close its upcountry showrooms to take up the strategic alliance with distribution agents. Now, the whole principle for this question is you're going to still you're going to draw up your profit statement, okay? And the profit statement you're going to draw up is before, if the decision is not taken and when the decision is actually taken. You get it, eh? To see how you're transforming from the other. And of course, the principle is if you get a lower profit, then you shouldn't close. If you get a higher profit, then you should close. Now, one of the other things you should also know when it comes to let's say closing one of your either branch or whatever it is, you're not just closing off the operations, but this may have an effect on your fixed and the variable costs, like they have told us here, okay? Now, ours is we can determine the profit statement before the change, okay? Just the current profit statement. And how we shall do, course, we shall have our dining here. Since we are looking at two areas, we are looking at Kampala and upcountry. So we are going to draw up a profit statement in this format, in a similar format like this. Okay. So we should be able to get our total sales for our total sales revenue for Kampala, and then the total sales revenue for upcountry as well. Okay. And then we should be able to also determine the respective costs. At least they have given us the respective costs. So for the dining sets, we can find the respective costs. And then for the sofa set, in the same way, okay? And then when it comes to, of course, they are telling us that the fixed overheads is 1015, okay, 101550. Now we may not have to allocate that. Basically, it's a profit statement, okay, where we are going to have our contribution and then have the profit. Okay, so we're not going to allocate this fixed overhead. So once we know that, ours is also to, just a moment. So ours is also to proceed to look at the other scenario where when in a scenario where we have the distributors, the strategic alliances, and then be able to compare the profits. Maybe just find out, Henry, what was your challenge on this question? What exactly, if it was Henry who brought up this question?
Yes,
what was
yeah, my challenge, I want you to I wanted to how, as you said, that the fixed cost, you're going to ignore it because it looks to be that's the annual fixed cost, yet you are just working for a month. That is, you made it clear. And also now on the revenue, they are giving us sales output and price. So are we supposed to multiply?
Because we have to find the total revenue, okay? We have to basically find the total revenue. Remember, we use this to ask yourself. Remember, the decision that we are trying to make is based on the forecasts for July 2017. Okay, we already have the forecast they have given us here. Okay, but before that, before jumping to July, they have given us information for which period? They have given us information for April 2017, and they have told us that sales, the sales will continue through. We don't expect them to change, isn't it?
Mm-hmm.
Up to that end. So ideally, when we are doing our profit statement, we base on the total revenue. Okay, we basically based on the total revenue. And then also, one of the other things they have also indicated here, they're saying that if PFM accepts this proposal, the upcountry showrooms will be closed with effect from July 2017. This will decrease the overheads by this value, okay, by 70% and fixed costs by 25%. So the fact that they have given us costs in terms of monthly, and even for July they have even given us values. What I would basically do here, if they have given us this as our annual fixed overheads, okay, yours is to actually do what? Yours is to get this down into monthly, okay? For example, if these fixed overheads would divide them by 12. If you're making the analysis for 1 month, and like you've seen, the information they have given us is for basically 1 month, so we cannot look at the whole period. You get it, eh?
Yeah.
So we may need to divide that by 1 month. And remember what they have given us here. They have given us the variable costs, okay? So they have given us for the dining set, and then they have also given us for the sofa set, okay? Now, ideally, these are unit variable costs. So for these, you don't have to do times 12, divide by 12, because they are already unit variable costs. So these ones are just multiplied by the respective numbers that you have here, the units. You get it? These units would help you to determine the direct material cost, the direct labor cost, and the direct overhead cost. You get it, eh?
Yeah.
Yes. So you're able to determine before
Excuse
the
me, sir. I
decision.
think my network is bad. I didn't hear that.
I say that they have given us the annual fixed cost, which we have to divide by 12. And that's why it's good for you to read and pick those keywords. Get this value, divide it by 12 to get your monthly fixed overhead. And then for the unit variable costs, when you're doing your profit statement, okay, yours is these, they have given you these are units. So based on what you have here, for example, if we are looking at 10, if I want to determine my direct material cost to be 10 times the 555,400, I'm able to determine my direct material cost for if I have an output of 10. So the sales output will also dictate how much we shall have on the variable costs. You get it, eh?
Mm.
Yeah, so that is what you basically do. So you do a profit statement before and a profit statement after. And what I mean by profit statement, you're looking at the total revenue, you're looking at the total variable cost, you're getting your contribution, okay? And then you're able to get your fixed costs, and then able to get the profit, okay? So that is what basically happens. Now they have told you something here, that the variable overheads will decrease by 70%, and then the fixed costs will also decrease by 25%. So when you're looking at after the decision has been taken, the portion of the decision being taken, then you should basically have to come and affect these ones as well, okay? So you have, remember you have this, you see this that we have, the variable overheads.
Yeah.
And one of the things that I want you to note is that when they say variable overheads, they're not meaning variable costs. In most cases, when they say variable overheads, they have given you the variable overhead cost. So you only apply it on the variable overheads. Is that clear?
I beg your pardon. You're saying that when they say variable cost or variable overheads, you only apply on?
I'm saying variable costs and variable overheads. Okay, like variable overheads are part of variable costs. But some students confuse when they see, for example, they see something here that they have told them that variable overheads will decrease by 70%. They want to apply the 70% even on the direct materials as well as even the direct labor. Yet it's only applying to the variable overhead. You get it, eh?
Yeah.
Yeah.
So
that's the first.
How about the apportionment of the fixed cost?
For this question, you don't need to okay, for the apportionment of the fixed overheads, you don't need to apportion them in this scenario.
Okay.
Yeah, because basically your decision here is going to be so much about the total profit. So you don't need to get a distribution between it, because what we are doing for the first scenario, we are using this. For the second scenario, we are using this times, since they have given us that this will reduce by 25%. So that value times 75% is what we use.
Okay.
You get it, huh? So that is what we do. But when it comes to the sales, I also need to highlight this. When it comes to the sales, after we've made the decision, we should consider using this. We should consider using this information, where they're telling us that the distribution agents already have put in a sales order for July 2017 of 60 dining sets. At how much? At 1 million. So this will be your revenue for up country. The 60 times 1 million, and then the 150 times the 1 million as well. Okay. And then they're also telling you that they're also giving you how much they expect to sell when it comes to the Kampala. So you're able to use this one as well as this one after you've made a decision. So you're able to compare the two profits before and after, and then easily make the decision.
Excuse me, sir. I think you have kind of mixed on the fixed cost, because at one point I heard you say that we divide because here the question is saying, advise PMF on whether it should close its up-country showrooms to take up the strategic alliance with distribution agents basing on forecast of July 2017.
Yes.
And the fixed cost is an annual one, meaning it's 12 months.
So you divide it by 12.
Then that means you'd have gotten the portion of only July.
You'd have gotten the portion of July after the decision. Okay, when you divide that, you actually get you get the portion before the monthly portion before we even get to July. Remember, July is 25% less. You get it, eh? So when you divide this by 12, you basically get something like, for example, for April, before we make the decision, you get it. So the fixed cost you get when you divide this by 12 are basically for before we contract our agents. In the month of July, the fixed cost we are going to use is this divided by 12 times what? Times 75%, because the fixed costs are decreasing by 25%. You get the principle?
Yes, actually, I was getting, at one point you had said we ignore the fixed cost. That is what was confusing me a bit.
No, what I said we ignore is allocating them between upcountry and Kampala. We don't have to allocate the fixed costs between the two areas, basically, because our decision is based on the total. You get it? So even when you, on your profit statement, when it comes to the fixed cost, just move the value to the total column. Don't have to distribute between the two products, the two products or the two regions. You get the principle?
Yes.
Yeah. So that is what exactly would happen. So I hope that was, and then of course these other three factors. Remember those other three factors that these factors could be just around. You know, if you're doing this yourself, you have some level of control. You get it, eh? So one of the factors you need to also to consider when it comes here is the reliability of the agents. Okay, is reliability of the agents, and also considering that these guys are going to sell the sofa sets at these values. The other you to consider is whether these sales will not affect your existing customers. Okay, so the reliability, but also things to do with quality, okay, and also trademark, okay, because if distribution agents are the ones that are selling to you, they probably work with other competitors that might actually pick some of your trade secrets. Okay, I think I gave you those points. You might you have them when we're trying to look at this topic, but you can easily make just a kind of basically you're trying to look at other qualitative reasons that you might look at. Okay, around quality, trade secrets, about your customers, the ones that you're already serving. Okay, yeah, several of them. Let's just look at this number one question here and see. So was the number one question here okay?
No, you can talk about it a little.
Okay. So this one was asking us to determine, they're saying using the decision tree analysis, advise KMC management on the best option to be undertaken without conducting market survey, and then when market survey is conducted, and then describe the implementation process of the T2M, and then they discuss the impact of T2M on the overall performance. I think we did this in the last class. So let's just try to look at the detailed question and see how the decision analysis tree would be done here. So they are telling us that Kitha Medical Care, established in 1960 by missionaries, is the largest referral hospital in Kabarole district with the capacity to handle 700 patients. They are telling us that currently the hospital is constrained with the ward space and personnel due to increased admission cases. KEMC's board has considered this as an opportunity to expand the current hospital and set up a new branch in Fort Portal. Expansion of the current hospital will increase inpatient capacity to 1,000. It involves purchasing of 3-acre land from the willing neighbors at 9 million per acre, and construction works will require 280 million. They're telling us that expansion will increase the hospital administration expenses to 184 million. Okay. And then they are telling us that, and the permanent staff salaries will go to 324. KEMC will need to employ 4 part-time specialists at a rate of 50,000 per hour, and each specialist will work 4 hours a week. Construction of a branch in Fort Portal requires purchase of 20 acres of land at shillings 2 million per acre, and it is planned to have a handling capacity of 1,500 patients. Construction works will cost 400 million, and shillings 548 is expected to be incurred annually on administration and staff expenses. Okay. The branch will need to employ 6 specialists who need to be paid 60,000 per hour, and each specialist. KEMC anticipates annual turnover of 800 million before completing any of the proposed projects. So before it does anything, However, there's a 65% chance that the increase in turnover will be significantly high after completion of the proposed projects, and annual turnover increments include are indicated below. So we have option to expand, we have high, we have 210, 220, and then low, we have 160, okay, in terms of revenue. And then we also have, for the branch, we have high is 280, and then we have the 85,000. So they are telling us that due to uncertainty, KEMC has a policy to carry out a market survey in order to determine the stakeholders' attitude towards the revenue generating capacity of the proposed project. It was discovered from the recent market survey that the projects with the high revenue generation capacity had 70% optimistic attitude, okay, and 30% pessimistic attitude responses from the stakeholders. For projects with low revenue capacity, market survey indicated 25% optimistic attitude and 75% pessimistic attitude responses from the stakeholders. So they are telling you that using a decision tree, okay, advise KEMC management with the best option to be taken. So they have given us 2 cases here, okay? Without the market survey, and then they have also given us when the market survey is conducted. Now, this question, I hope you remember when we are covering one of the topics called risk and uncertainty. And then we also spoke about what we called perfect and imperfect competition, okay? And how to incorporate that within our respective decisions, okay? So with this question, you needed to have, of course, the knowledge of both the 2 concepts, as well as they have also gone ahead to bring in aspects of high and low, okay? We also have the high and low method as well when it comes to us being able to compute the respective values. So for this question, yours is to first get the information, okay? The information that they have given us right from above. And most of the information they have given us is around the costs and the revenues that will come from the respective decision. So yours is to first summarize those as well, okay? So when we go up here, as you can see here, they are telling us that, now remember the questions, it's good for you to take note of the questions. They want us to advise KMC management on the best option to be taken without conducting market survey and when market survey is conducted, okay? So without conducting market survey, we are going to ignore this information here, okay? We shall basically not use this information at first, without, okay? And yours is to now go back here. Remember, management is seeking for the best option, okay? And what options do we have at hand? We have an option to expand the hospital or set up a new branch. That is basically what we have right there. So what that means is we have to determine how much, in terms of how much are we making on each of the respective projects, okay? So as you can see, they're telling us KMC board has considered an opportunity to expand the hospital or set up a branch. So this is basically what they're telling us, what that will happen when it comes to setting up, expanding the current hospital, okay? So yours is to determine basically what is your profit that is going to come from here, from each of these before even you draw up. I think you know very well that when we are drawing up our decision tree, we have two things, okay? We have a square, okay? We have a square which represents basically a decision point, okay? We have a square which represents a decision point, and then within the square we have, of course, two lines. We have different lines that represent the choices, okay, between the different courses of action. Now, in this case, we basically, when you try to read through this information, we basically have only two lines that are coming from the first, from what you would call your decision point, okay? So you're able to determine what is the profit. Now they have told you here, expansion of the current project will increase inpatient capacity to 1,000. Then they're telling us, okay, now this is from the aspect of revenue, okay? And they're telling us that it involves purchasing of 3 acres of land from willing neighbors at that much per acre. Remember, this is per acre, so you have to multiply this times this. Now you have to list the revenue and the costs, okay, on each of them. And then you're able to go, and they're telling us the construction work will require shillings 208. So this is an additional cost. They're telling us that expansion will increase hospital administration expenses. So include that as well, and also include this as well, okay? And then they're telling us that KMC will need to employ 4 part-time specialists at a rate of 50,000. So you're able to get this cost as well. 4 times, because they have told us that 4 part-time specialists at the rate of this. So 4 times 50, okay, times They're telling us that they are going to work times 4 hours times 52 weeks. Remember, the year has 52 weeks. So if we are looking at an annual period, we'll also be looking at that. This is a week, okay? And those similar expenses are also here, okay? Now, remember they have told us something here. They're telling us that KMC anticipates annual turnover, okay, before completing any of the projects. However, there's a 65% that the increase in turnover will be significantly high after the completion of the project, the proposed projects, and the annual turnover increments. Now, this alone, this would actually now add you what? This would add you another line, okay? This would add you another line to what we want to do here. So what we may want to basically do is I don't know if I have here my what I would call it, my paint. Let me try to get a software that I can basically use here to help us on this question, because I cannot use Excel. So just a moment. Maybe. Okay. So I want to use this to demonstrate what I'm saying. So I have that, okay? I have that at hand. So what I'm basically going to do is I'm going to first do two things right there. So I'm going to have this line. I'm going to have that line. And then I'm going to have this line. Okay. So this is like my decision point, okay? So what they are trying to indicate here, they are telling me that KMC anticipates annual turnover of 800 million before completing any of the proposed project. However, there is 65% chance that the increase in annual turnover will be significantly high after the completion of the projects, and the annual turnover increments are indicated as below. Okay, so this is what they are trying to give us when it comes to here. So remember, we have two projects. Okay, we have two projects that we have here, which is construct and not construct. So let me just try to so I want to have that one there, and then I want to have another one here. We just copy. Okay, so we have those two, we have cases here. So they are telling us that even before doing what? Before them going ahead to do the, is it before expanding? Okay. Just a moment here. So they anticipate this turnover before completing any of the projects, okay, before they have taken on the project. They're telling us that, however, there's 65% chance that the increase in the annual turnover will be significantly high after completion of the proposed project. And they're telling us that the annual turnover increments are indicated as below, okay? So we have different options here. So we have for expand, and then we have the high, okay? Now, expand and then branch. So we have the aspect of the high, and then we also have the aspect of the low, okay? But remember what they have told us here, that there's 65% chance that there will be an increase in what? In our annual revenue, okay? And they have given us these respective values that we need to basically apply. Now, from what we basically have here, we shall try to create what we call, remember what we said about the circle, which is outcome point. So we're going to create an outcome point. Home. So we shall create an outcome point there, and then create an outcome point here. Okay. And this outcome point, remember we have we have the high and low, okay? So we shall create something there and also create something there like that. Create something there and also create something here. Okay, so we have to come and do what? And incorporate these respective values here. Okay. Remember, one of the lines is expand, and then one of the lines is actually do what? Not expand. So we have to come and they have also told us that there's 65% that turnover will be high significantly. So it means that the respective percentage, the other remaining percentage is actually 35. So if you want to include the percentages, you can call this to be expand. This can be your expand. Okay, it's not working for me. So this can be expand, and then this can be your, sorry, I call this expand. This can be your high, okay? This is already expand. This can be your high, and the other can be your low. And then this can be your low. So what you do is put 65% here where I'm clicking, put 65%, and then put on the low, put 35%. So you do the same thing also when it comes to here as well. This will be 65%. And then here, this will be 35%, like that. Okay. Now they have given us what? They have given us respective values here. Okay. They are telling us that annual turnover increments for high and low when under expand. So you're able to incorporate these increments, okay? The 220 and 160, and then the 280 and 85, okay? But what you should not also forget is what we are calculating here, okay? You're able to determine now, they have given us this in terms of capacity, but as you can see here, they have not given us such kind of revenue information. So for revenue, we are basically using the information down, okay? So yours is to look at the aspect of costs here, okay? Aspect of costs here. Get the total cost there, and also get your total cost when it comes to this option, okay? And that is what you basically would have the other side. Now, remember, we have the additional annual revenue. Now, one of the things that you may also want to look at here is, remember, we have additional costs, okay? We have additional costs, and these are annual values, okay? So whatever they have given us in terms of weeks here, you have to be, that's why I was saying you multiply by 52, okay? You multiply by 52. And of course, we have, within here, we have a fixed cost, okay? Because when it comes to, they're telling us that they will purchase land, that value, and then the construction will actually cost us this other value. These are like fixed costs, okay? And then we also have now, okay, this is not a fixed cost. This will be a fixed cost in its own, okay? This will be a fixed, this is not a fixed cost. This will be an annual cost. Okay, it's a fixed cost, but it's an annual cost. It's not a one-off cost. We have, maybe what I can say, we have one-off costs, and then we have the other respective costs, okay? So you need to be able to know that as well. So once you are done inputting the respective information, now for you to easily make a decision, okay? For you to basically make a decision, what we said when it comes to working with these decision trees, we basically, what we do is we start from here, okay? We basically start from here. So we have this value, we have the annual turnover when it comes to what? When it comes to expand, okay, and high. So we're able to get that value that we've put there. I think it was about 220 multiplied by this. It gives us the EV at this point, okay? And then we're also able to get as well as the same thing as well as here, okay? And then we're able to use those values to come to this point, okay? Of remember, this point is this is like an outcome point. This is like increase in revenue, high and low, okay? Now, one of the things that you also need to take into consideration is, of course, definitely, we also have we have the fixed costs, okay? Which fixed costs are the whole cost that we are going to incur are right here on expansion and of the current. Here you basically look at the profit, and the other costs, you look at them from this perspective. Okay, this point, the other respective costs, the ones that are one-off, you look at them from right here, and then from that you're able to get the whole cost along this decision line, and then you're able to get also the whole cost along this decision line. And then once you get that, then you're able to compare the two. But you call it the EV. It's basically the expected value of this whole outcome point, and then also this as well. Okay, so do we get an idea, or has somebody done this before and maybe you have a direct question? So I don't have to go so much in detail. Have you tried out a question on this? Or have you read this topic? Can I hear from some people here? Anyone read it?
I tried one on decision tree, but it was a different number. But though the concept is the same, my only confusion here was the issue of how the one I did not have anything to do with the costs were there, but then how I drew it, I didn't incorporate the costs. I was not sure where do I put the cost, but I just made it as part of my workings.
Okay. And somebody, did somebody else try that out as well? Because one of the things that, as somebody else comes, one of the things that you need to know is when we are trying to look at the at the point of, let's say, the outcome point, ours is to look at the profit. You get it? So that's why they have given us the costs, and they have also given us the incremental revenue. Okay, so we can be able to get the respective profit on each of the different lines as well. And then of course we have the one-off costs, which we should also be able to look at. Somebody else has a question? I would encourage you, if you have not done this topic much, there are some questions that are in the iSPAL book. Okay, you can try to go through those two questions. They can give you some good start when it comes to these. I think it's either one question or two questions. I may need to confirm. There are two questions. Just try to create some time to go through those, so that any questions of the kind that comes, you can easily be able to do something. You get it, huh?
Now I have another question concerning this number. So for the costs, would put the cost on that other line you are showing us. So that means we do the working of costs somewhere else, aggregate them all, and then come and put it in the decision tree.
Yes. You have to have a working somewhere, and that work will definitely also bring you marks.
So now the incremental revenue, do we also add it up to the part of, do we also add it with the expected value of the EV something, or we only take the expected value amount only against the costs?
I beg your pardon on that one.
Okay, like you see, if we look at expand, under high, we have 65%, then low, we have 35%. So if I do the 65% times 220, I get some figure there. Then also the 35 times 160, then I would have gotten the total expected value for that line of expand. Then now, my question is, where do we incorporate the incremental revenue, the incremental what should I say, turnover? I don't know if I've mixed it up, but I was wondering, this other incremental revenue they're talking about, do we also add it to be part of the expected value, or we only take the expected value against the costs?
Okay.
I don't know if I've made it clear.
The principle here is you want to basically get the profit on each outcome point. You get it, huh? So what that would mean is that they have given you incremental revenues, okay? And they have also given you the revenue at the start before taking on. Basically, the 220 is an addition to 800 million. You get it, huh? To 800 million. So you may choose to get 220 and add it to 800 million to be the total turnover on, let's say, on your expand high. You get the principle. And then you pardon?
No, I was just saying yes.
Yes. So you're able to do that. Now you also know the expenses that we have. And the expenses under expand, I already say that we have your expenses. They are telling you that they have actually given you the expenses are here. They are telling you that the expansion will increase the hospital administration expenses by how much? By 108 to 184. The permanent staff will increase to this value. And then this will, this 4 specialists, I said multiply it 4 times 50. They're telling this times 4 hours times 52 weeks. You're able to get the cost for these 4 part-time specialists. So this will be like your costs that are actually coming as a result as a result of this expansion. As this will be like the annual costs. You get it, eh? These are one-off costs that we should also basically take into consideration, because we are trying to also make a decision on either to expand or to construct. So these are also part of our decision, okay? But when you're determining in terms of profit at either on expand high or low, you may choose to get the total revenue, which will, for example, it is expand will be 220 plus 800 less what you have as your respective cost, and able to get the profit at that line. Are we together?
Some clarity here. So, meaning under expansion, we are not going to consider those are the cost of purchasing the land and the construction.
No, when we're just when we're trying to look at expand, when we're trying to look at the expand or what? Expand high or expand low. You get it, eh?
Yeah.
We are saying that we are looking at the annual, because remember when if you're getting profit, these are capital investments. They are not part of your profit. You get it, eh?
Like yeah. Okay.
So yeah, so before you incorporate them, because they are going to be part of your cost. You get it, eh? They are going to be part of your cost. But when you're determining profit on your, let's say, line of expand high, you want to leave them out because they are not part of the profit.
I'm thinking they're part of the cost for the expanding high and low.
Yeah, they are part. But what I was trying to bring up here is that these are capital investments from your simple accounting. Yeah. If you're determining your profit, you don't have to incorporate the capital investments there. You get it, eh? So I don't want you to call it profit. And remember, this is the annual turnover. These things are going to be around for more than 1 year. You understand?
Yeah.
So I want you to work these things to show the examiner that you understand these principles well. You get it, eh?
Yeah.
Yeah. So that is what that's what I was trying to bring home.
It's all right, man. So those are capital investments, like the capital expenses.
But they also affect our decision.
Yeah.
You get it, eh? Yeah, they also affect our decision. But you basically don't. What you want to do is you don't want to basically incorporate them add them to when you're doing the profit, like add them as part of your expenses. But you definitely include them when you're making the decision.
Okay, that's clear.
Yeah, but at least look at those respective questions. They'll be able to help you, guide you throughout. I believe that all of you that are part of this call have access to these questions. I would encourage you to go through them. You'll be able to get the message, as well as get the message also when it comes to the value of this information. Now, would you regard a market survey to be value of perfect info? Because for example, here they're telling us that due to uncertainty, KMC has a policy to carry out a market survey in order to determine the stakeholders' attitude towards revenue generation capacity of the proposed projects. It was discovered that from the recent market survey, that projects with high revenue generation capacity had 70% optimistic attitude and basically 30% pessimistic attitude responses from stakeholders. And then we also have basically this information. So from this, you can be able to find out in terms of what is the value, okay, of this information that we are getting. Is this perfect information or it is imperfect information? Would you regard this as perfect information or imperfect information?
Yeah, I'll say perfect.
Yeah, of course, it's just a market survey.
Yeah, so it is imperfect.
It's just a market survey. It's basically just it just gives you, because okay, perfect information is one that is it's basically 100% accurate prediction. You get it, eh? Yeah. And then imperfect information is basically forecast. Okay. Here the forecast is usually, of course, correct, but can be incorrect as well. So a market survey would fall under that category. Okay. So you'd be able to follow through the principle. But for matters of time, I would encourage you to look at those questions, just to, I think this has opened our eyes that any topic can actually come within section A. So you don't want to go, as well as also be able to look at these as well. The implementation process of T2M, we actually did this process. You remember? I know we were trying to run very fast, but at least those last notes that I did give, I think had that T2M somewhere. So I would encourage you to go through some of them. I know at a time like this, there's a lot of pressure, but yeah, if you can use, now when you fall on such a question, it should be able to help you go back and see. I think I did T2M. I jumped most of those things. T2M was around here. This is T2M. Total quality management. So that's what it rotates. We had the X-sticks. We had the critical success factors. We had the respective costs. Did I give the process? Cost of I may need to find out. Okay, let me try to see if I can find you that process. I thought it was here. Did somebody see it somewhere? I'll try to find it and see. Yeah, but the questions should also help you to guide you on what kind of material you should be looking out for. Yeah, the implementation process. And one of the other things also is I want to say that even when you don't, like, for example, for these theoretical questions, if you can understand what T2M is, because here the examiner is asking you to describe. you can easily be able to put down what you think in terms of what you think would be the right in terms of the steps. Okay, but this, like for example, here they're asking, they're not even saying steps, but they're saying the process. So you know that T2M involves basically where everyone is actually involved in the quality management for all the departments. So you can be able to write a write-up to earn those marks. Even if they are half of the marks, at least you can be able to get something, because when you look at what we have, actually even the iSpar book does not have the process. So basically, you can go ahead to explain, okay, what might basically entail. As you can see, we had different components, and we also had respective costs and so on. So you may not get the process in its own. I think you can see even the critical success factors, you can be able to bring them up there, and what is needed. The X sticks right there, and then these respective things. Yeah. So around there, as long as you're able to put up something that can convince the examiner. Some of these things are usually general. It's not like there's like the way they say describe. It's not like there's a fixed answer. Like these are steps from this, you move to this, you move to this. Okay, yeah. And then for the impact, in the same way, you also have once you're able to go through the notes, then you're able to get the impact as well onto them. So anyone else found a question that we can conclude with today's class? I think the whole thing that I can say basically is, of course, there are many things, and I believe that you've at least tried to go through most of these things. I think for these last 2 days, is it even 2 days? I think you have now 1 day. Yours is to make sure that you just look at the past five sittings, okay? Look at the past 5 sittings and look at some of those questions that they have set in the past 5 sittings. Should be able to give you some level of trend of how these exams have been, okay? And of course, you should not restrict yourself to the 5 sittings, but those should be able to give you what are some of the areas that you should be looking out for. In the same way, also, if you're done with the five sittings, you can also try to look at in terms of the rest of the periods, like from at least around this is 2021, at least from 2018 to date. Just look at those papers and make sure that whatever is there, at least you have some level of understanding, okay, on them. Tomorrow we will do we'll see if we can have a session. Just try to go through and see if you have any interpretations that you may need tomorrow, so we can also have just a similar session at around a similar time, just for guidance purposes. I don't want to go so much in detail because I know we have a limited time. And when you concentrate on a given topic and doesn't appear, that would be basically wasted time. So a time like this is making sure that you get the concepts and you understand what would be the approach. Okay, yeah. So I think that is what we can do. Do we have any other kind of question that we came across, or before we close, or in any kind of guidance?
I think from me, there's nothing else for now, because I wanted us to do some ABC question, but I think we can run through it tomorrow because I want to look through it again. Then maybe tomorrow I can ask some few things.
Yeah, I think I tried to go through, and I think for this, I would love to know where your challenge is. You get it, eh? Like where exactly you have your challenge, so that we don't have to go through the whole number. And one of the things that you can do, you can even at least we did one of the numbers here, so you can find out, look at numbers that have been done before. Okay, even you can find solutions on the iSpow, so that when we come here, you're able to tell me what is exactly your area, like the area where you feel you need clarification. Okay, maybe when it comes to determining the absorption rates and so on. So at least those are the kind of questions that I may want to basically get.
And then for me on my side, I think standard costing, I have seen many questions, and I imagine that I think we're running through the notes very fast, so we did not do a lot on them. Maybe I will try to look for some, and then tomorrow we'll look at them, because standard costing, actually I don't have any those things of pricing, scheming.
Okay. You don't have notes on that, the price scheming and price penetration?
I tried to look at the iSpow textbook, the study pack, but I did not see anything direct on that, on the scheming and the penetration thing.
As a calculation, or as a kind of theoretical questions?
The calculation also, because I saw some question that had something on calculation on penetration and scheming.
Which year was that?
I need to, maybe I'll just look for it and then I bring it tomorrow. I'm now not sure.
Okay, Kale, all right, all the best in your preparations. Bye-bye.